I want you to imagine something. Picture this. You wake up one morning and discover that the bank holding the savings of 1 in 3 people in your country is gone. Not closed, not failed for market reasons, emptied. $1.8 billion, moved through a network of shell companies across 28 countries, methodically, over years, almost in plain sight. And the man accused of orchestrating it has never been convicted, in any country, in the world. This is the cold file. To understand how something like this even becomes possible, we need to go back to Ukraine in 1991. The Soviet Union has just collapsed. The economy is in freefall. Inflation skyrockets to 5,000%. State-owned enterprises are sold for mere pennies. In that chaos, a small group of people grasp something that most didn't. In a country where the rules are unwritten, whoever controls the money controls everything. In 1992, in the city of Dnipropetrovsk, PrivatBank was founded by 2 businessmen, Hennady Boholyubov and Ihor Kolomoisky. Kolomoisky? That's a name you'll hear often in this video. Aggressive, controversial, a man who could construct financial structures that made Western lawyers do a double take. By the mid-2000s, PrivatBank had become the largest private retail bank in Ukraine, holding over 30% of all bank accounts in the country, with 20 million customers. When a bank grows that large, it becomes too big to ignore and too big to fail. That single fact laid the groundwork for everything that follows. Okay, here is where it gets genuinely interesting. The scheme started with something completely ordinary: bank loans. Banks issue loans, that's what they do. But look at the companies receiving those loans. Registered in Cyprus, the British Virgin Islands, Luxembourg. Jurisdictions where the real owner of a company can remain completely anonymous. These companies would receive a loan, then transfer the money to another company. Also a shell, also offshore. That company would transfer it again and again. On average, 7 to 14 separate legal entities before the money reached its final destination. And at the end of that chain, the money landed in real assets, real estate in Switzerland, equity stakes in Israeli companies, bank deposits in Monaco. And the loans stayed on PrivatBank's books as assets. Now listen to this very carefully. By 2014, 97% of PrivatBank's entire corporate loan portfolio had been extended to companies connected to this network. 97%. The entire capital base of the bank was built on loans that were never going to be repaid to companies that barely existed. But here's what sets this case apart from every other financial fraud I've examined. Most financial crimes of this magnitude unravel due to carelessness, a forgotten paper trail, a talkative witness, or a transaction that doesn't add up. What investigators uncovered at PrivatBank was the exact opposite. This was a machine meticulously fine-tuned over years. Let me explain how it functioned, step by step. Step 1. PrivatBank issues a loan to a legitimate Ukrainian company, complete with an office, employees, and a credible business facade. Step 2. That company uses the loan to pay for goods or services from a Cypriot entity, resembling a standard trade transaction. An invoice exists and everything appears legitimate. Step 3. The Cypriot company receives the payment and then transfers it to a British Virgin Islands company as a loan repayment. Step 4. The BVI company channels the funds into a bank account in Latvia, Liechtenstein, or Malta. And just like that, the money enters the Western financial system with no visible ties to Ukraine. It can now be invested in property, stocks, or private equity, completely clean on the surface. The entire cycle wraps up in under 2 weeks. Ukrainian investigators later identified over 400 distinct legal entities involved in this network, spread across 28 jurisdictions. And here's the most unsettling aspect of this story. Most of this was technically legal. The loans were documented, the trade transactions had invoices, and the offshore companies were properly registered with real directors hired through professional services firms. The illegality lay in the intent, in the fact that every component of this machine was controlled by the same small group of individuals. But proving that in a court of law across 28 jurisdictions with varying legal standards, that presents an entirely different challenge. Revolution. A new government emerges, but the economy contracts by nearly 17% over 2 years. The hryvnia loses 2/3 of its value against the dollar. For the shell companies borrowing from PrivatBank, many loans were in dollars while their collateral was in hryvnias. As the exchange rate shifted, the gap between what they owed and what they had became impossible to ignore. The National Bank of Ukraine, now led by reform-minded officials, scrutinized the balance sheets of the largest banks. What they discovered at PrivatBank was alarming. The IMF, in the midst of negotiating a bailout for Ukraine, set a condition: recapitalize PrivatBank or nationalize it. For 18 months, negotiations unfolded. Kolomoisky and his team promised restructuring, submitted plans, and provided documentation claiming the problematic loans were being resolved. However, the National Bank's reports revealed a different story. Bad loans persisted, with new shell companies replacing the old ones. The numbers changed, but the problem remained. On December 18, 2016, at 10 o'clock in the evening, Ukrainian Prime Minister Volodymyr Groysman went on national television and announced PrivatBank is nationalized. By morning, the government had injected 148 billion hryvnias into the bank, approximately $5.5 billion, to prevent its collapse. Every Ukrainian taxpayer paid for that. After the nationalization, the numbers became public. PricewaterhouseCoopers conducted an independent audit published in 2018. The official figure revealed that $5.5 billion moved out of the bank through related party lending schemes. Other estimates, accounting for currency adjustments and traceable funds, ranged as high as $7 to $9 billion. For context, Ukraine's entire GDP that year was around $90 billion. This wasn't just an accounting entry, it was a national wound. The deposits of 20 million customers, ordinary people, were ultimately protected, as the state guaranteed their savings. But remember, the state is its citizens and the citizens paid. In the years that followed, the Ukrainian government filed civil claims. The UK's Serious Fraud Office opened an investigation while authorities in Cyprus and Switzerland began their own processes. US courts saw claim and counterclaim, with Kolomoisky himself suing the Ukrainian state, arguing that the nationalization was unlawful. In September 2023, Ihor Kolomoisky was arrested in Ukraine, charged with fraud and money laundering in connection with PrivatBank. He denied all charges, claiming the case was politically motivated. You know what strikes me most about cases like this? It wasn't invisible. Thousands of people worked on this. Auditors, prosecutors, journalists, international investigators. The documentation runs to tens of thousands of pages. Everyone could see the shape of what happened. But financial crime at this scale is specifically designed to survive scrutiny. It is built in layers so that each layer, examined on its own, looks defensible. Proving criminal intent at the very top, in a court where the standard of evidence is extremely high, is one of the hardest things to do in modern criminal law. $1.8 billion, or 5.5, or 7, depending on how you count. No criminal conviction? In any country. The money, most of it, not returned. The file is still open. If you want to go deeper on the next case from this part of the world, one that Western media barely covered, subscribe. The next episode drops this week.